Hey everyone, this is Ronak Ahuja. I welcome you all again. In this video of today, we'll be discussing the taxability around the purchase and sale of equity shares, be it in the form of delivery-based trading, intraday trading, or trading in futures and options. The new investors find it a little difficult to understand the taxability aspect. So today, let's try and simplify this. So without wasting any further time, let's quickly begin. The shares in the stock exchanges are mainly traded in three forms. The first one being the delivery-based trading. In case of delivery-based trading, the share trader or the investor purchases the shares by taking delivery of such shares into their demat accounts. This means they hold the shares for more than one day and the positions are not squared off within the same day. This is called delivery-based trading and is one of the most common forms of trading in India. The second one being the intraday trading. In this form of trading, the share trader or the investor purchases the shares, but they do not take the delivery of such shares. They simply square off their positions within the same day. This is called intraday trading. And the third form of trading is into futures and options. In this form, the investor basically speculates on the price movements by entering into derivative contracts. So, these are the three forms of trading of shares in the stock exchanges. Now, let's discuss the taxability of these shares in these three forms individually so that you understand it better. To start with, let's begin with the first form of trading, which is delivery-based trading. In case of delivery-based trading, the investor purchases the shares by taking the delivery of such shares into their demat accounts. And any profits that arise from the sale of such shares would always be treated as income from capital gains. In almost about 90 to 95% cases, the investors fall in this category. Because here, the main objective is to earn through dividend or through capital appreciation by changes in the prices of the shares. So, about 90 to 95% investors fall in this category. However, there is a certain section of people for whom this type of income would be treated as a business income. In case you're a professional trader who is into frequent buying and selling of shares, that too in a very substantial amount, and treats such shares as their stock in trade or inventory, then in such a case, such income would be treated as your business income. In simpler terms, if you're a professional trader, it will be treated as a business income. However, in most cases, it is treated as income from capital gains, that is for 90 to 95% investors. Now, these capital gains can be further classified into two broader categories. The first one being the short-term capital gain and the second one being the long-term capital gain. In case the shares are sold within 12 months from the date of its purchase, then any gains arising from sale of such shares would be treated as short-term capital gains. And in case the shares are sold after 12 months from the date of its purchase, then such gains would be treated as long-term capital gains. The reason we need to classify it into these two broad categories is because of the different rates of taxes in each of these cases. So now let's look at the rates of tax. In case of short-term capital gain, the tax rate would be 20% calculated on the short-term capital gain as per section 111A of the Income Tax Act 1961. In case of long-term capital gain, it would be 12.5%. However, there is one exemption available in case of LTCG, that is long-term capital gain. An exemption up to rupees 1.25 lakhs would be available onto the long-term capital gain. This means up to rupees 1.25 lakhs, no tax on the long-term capital gain would be charged. Now we move on to the business income. In case of business income for professional traders, the tax rate would be the normal tax slab rates. Yes, you heard that right. For professional traders who treat their income as their business income, for them, there are no special rates of tax. The normal tax rates would be applicable for them. That is the normal tax slab rates. Now, we move on to the second form of trading in shares, which is the intraday trading. In case of intraday trading, the trader purchases the shares without taking the actual delivery of such shares into their demat accounts. This means the trader squares off its position within the same day. So any gains that arise from the intraday trading of such equity shares would be treated as the business income and not as capital gains. This has been said outright by the income tax rules. Yes, you heard that right. Any income that arises from the intraday trading of equity shares would always be treated as a business income. Now, this business income is further classified into two broad categories. The first one is the normal business income, and the second one is speculative business income. Now, what's a speculative business income? Where in case a person settles a contract without taking the actual delivery of commodities, it is to be treated as a speculative business income. Now, this commodity can be anything. It can be stock, pulses, or even equity shares. Now, the bigger question is, into which category does this intraday trading fall? As per the income tax rules, the intraday trading falls in the speculative business category. And thus, any income that we earn from intraday trading of shares will be treated as a speculative business income. Now, although the tax rates that are applicable in both these type of businesses is the same, there is one fine difference. Now, what is that? In case of normal business income, in case you incur losses, it can be carried forward for up to 8 years. However, in case it's a speculative business income, it can be carried forward only for up to 4 years. This is the only difference. So, since intraday trading is a speculative business income, the tax rates that would be applicable would be the normal tax slab rates. However, the losses would be allowed to be carried forward only for up to 4 years in case of intraday trading. Now, we move on to the third form of trading in equity shares, which is the futures and options. In case of futures and options, the investor or the trader speculates on the price movement of the derivative contracts, that is, the derivative contracts of such equity shares. Now, in case any income is earned out of futures and options of equity shares, such income would always be treated as income from business or profession. Yes, you heard that right. Any income that we earn out of futures and options would always be treated as income from business. And this also has been set outright by the income tax rules. Now, under the business income, it would be treated as normal business income. Accordingly, the tax rates that would be applicable here would be the normal tax slab rates. And the losses would be allowed to be carried forward for up to 8 years. This means all the business expenditures that you incur will also be allowed as deduction from the income that you earn from futures and options. But remember, it has to be related to such business. So viewers, these were different forms of trading in equity shares and their respective taxability. Now, we have prepared a short summary for you also so that you can take a screenshot and remember the provisions accordingly. So viewers, this was all about the taxability of equity share trading. Now in case you want to know the taxability of other capital assets such as mutual funds or any immovable property being land or building, then follow the link in the comment section. In case you have any feedback for us or you couldn't follow any part of this video, do mail us at talklevies@gmail.com. Now thank you and stay tuned for more videos.